Hi, my name is Kristof Gleich, President and CIO of Harbour Capital Advisors. Welcome to another episode of Views from the Harbour. This week, we have a very special episode. I'm delighted that we're joined by Don Casturo. Don, how are you?
Very good, Kristof, and thanks for having me.
So Don is the founding partner and principal of Quantix Commodities. Commodities have been top of mind for a lot of investors over the last couple of years. So we thought this week we would focus on the asset class, and we thought we would do a bit of a state of the union of the Commodities Union, so to speak. And so, Don, before we jump into your views on commodities, why don't you tell our viewers a little bit about Quantix, who you are, what you do, and tell them a little bit about your background as well.
Sure. I've been involved in commodity markets for pretty much my entire career. Most of that was spent at Goldman Sachs on their commodity desk. Just over 4 years ago, I reunited with some of my ex-Goldman colleagues to form Quantix, with the vision of becoming a full service sort of asset manager for the commodities asset class, an asset class that was largely overlooked for the previous decade with good reasons because there wasn't a lot going on, but we felt that was due to change relatively quickly, and we appear to be right on that. The last 4 years have been very active in the commodity space, and Quantix, it's been a good environment for Quantix in that regard. We started with a relative value absolute return hedge fund, which we launched in 2019, and have since expanded our offerings into more thematic long-only vehicles that are meant to address things that are relevant in commodity markets like inflation or energy transition.
That's great. And so, very prescient of you, setting up Quantix 4 years ago. When commodities really began to matter again. So where are we now, reflecting 4 years on since you've launched Quantix? Commodities historically a very cyclical asset class. It looks like we're kind of in year 3 of a new secular bull market, really since the lows of March 2020. I believe, commodities were the best performing asset class last year. They were the best performing asset class in 2021. I guess the question is, will they three-peat and be the best performing asset class in 2023? So just give us a high level of where we are in the commodities markets.
Yeah, I mean, obviously there's a lot of sort of exceptional events that have happened over that period, but you talked about a secular bull market, which I still very much believe that we're in, and there's two main drivers of that, which are deglobalization and decarbonization, and these are things that are more permanent than some of the exceptional idiosyncratic events that we've experienced that have contributed to some of the commodity price action. But if you look at the underlying trends, they're really coming from this secular decarbonization and deglobalization, both of which are bullish for commodity prices because they affect supply, certainly the abundance of supply relative to what it was in the prior decade.
And maybe if we could sort of unpick that a little bit more, so the decarbonization, deglobalization, maybe put some numbers around it. What are you seeing in terms of like the investment needed? Like where are commodities particularly in deficit? Is it across the commodity spectrum? Are there certain areas, whether it's energy, precious metals, industrial metals? Let's sort of go into that in a bit more detail.
Sure. I mean, I think the thing that's interesting about decarbonization is decarbonization implies you're using less carbon. So that part is kind of relatively obvious in terms of like, we're trying to move away from fossil fuels. But what that has resulted in is the lack of capital flow into the supply of those fossil fuels at a pace that is going faster than the actual demand decline. So we're seeing some severe shortages, and certainly over the last couple of years, we saw some severe shortages in those fossil fuels when as demand was picking up coming out of the pandemic, because there wasn't the investment in resupply, because decarbonization says we're not going to use this going forward. So investors were logically not giving capital to the space. But what the name doesn't have in it is like the fact that if you're going to use less of something and you still need energy, you need more of something else. And this energy transition has been in somewhat topical, but not really invested in, and certainly not invested in from a commodity perspective. The majority of the assets that have flown to the space have been more on the technology side and trying to develop which technologies are going to assist in those decarbonizations. Even with electric vehicles, you've seen more money flow into creating the vehicles than creating the inputs to make those vehicles, which are the actual base commodities. And that's what really needs to happen to affect the energy transition, is that there needs to be more investment, i.e. more supply of the things we're going to need more of if we're using less carbon. In the meantime, if we don't do that and we're going to still need the carbon, then we need to give more money to fossil fuels, which, that's not my base case. I think there's a commitment to net zero and decarbonizing. So it's unlikely that we're going to see capital flow back into fossil fuel producers. But we haven't seen the real money flow into the alternative commodity producers. It's been more to the, as I said, the technology that is going to rely upon those commodities without the actual increase in flow to create more of the inputs.
You're talking over, call it the next 2 to 3 decades, right? This is a long-term secular theme and trend that there needs to be a capital reallocation from carbon-based commodities to more kind of green-based commodities if we're going to get all the way to net zero. But in the meantime, we still need to consume stuff, and we still need to supply and invest to meet how we live our lives. And I think what people don't appreciate is you've got to look at the supply and the demand, right? And even if we are in theory demanding less of something, let's say you're demanding less of oil in the future because we're going to transition to EVs and green energy, etc. You would think from a price perspective, if you're going to be demanding less of something, the price is going to go down. But actually, you need to keep investing in the supply to keep up, even if the demand's going to kind of drop off a little bit. So you can actually get, when commodities are less in demand, the price spikes up because there's less invested in them, which is definitely a bullish case. I remember listening and hearing about the case of mercury. Remember, like mercury, we used a tiny fraction of the mercury that we used to. But if you look at the price of mercury on like a Bloomberg terminal, it's, I think it's at all-time highs. So with today then, with inflation, let's talk a little bit about inflation, because it's hard to break apart the views on inflation and views on commodities. So how could an advisor justify holding commodities today in a 60-40 portfolio, call it, a 50-40-10 portfolio, take 10, put it into commodities? What's the rationale for doing that today if inflation is kind of seemingly peaked and coming down?
Yeah, I think there's a very clear rationale for it, honestly. I mean, as you just pointed to, prices are set, and this is economics 101 on the intersection of supply and demand. And you can't just look at low demand thinking you're going to get low prices. If you have even lower supply, you're still moving up that price curve. And what has happened in commodities in sort of the second half of 22, you've talked about how it's been a secular bull market, and they have been the best performing asset class. But even commodities came off in the second half of last year, and that was largely a function of, in a very short sort of term spectrum window, we had actually a reduction of demand and the expectation of even further reduction of demand as the world thought we might be going into a recession and cooling that demand. We did nothing to address the supply problems that we talked about on a longer term secular basis. But that demand destruction that was based on a potential hard landing and recession view would be even more devastating to equity markets, right? So Now the fact that markets are saying, hey, maybe the Fed or other central banks are going to pull off this soft landing, and we're going to be able to recover from this while still having some economic growth. You would expect that those expectations to mean we're going to now start demanding more commodities again. And as we've said earlier, even in this call, the supply just isn't there. So the rationale for me to why you should put commodities in sort of your portfolio allocation is if you expect your equities to grow, the biggest risk to that is if there's not enough energy to supply that growth, and kind of running into that same problem that caused inflation over the last 18 months was because we were trying to grow so fast that we were experiencing shortages, which led to that inflation. There's the potential for that to happen again. I would almost argue if you're going to own the 50% equities, you almost have to own the commodities just in case we run into that again. I could see not owning commodities if you're so bearish the world, you think we're not, demand, even with a low supply environment, the demand is going to be low enough, the commodities go down. But to me, if that happens, that's because equities are going down even more because we're just really in a recession. That's the only way I see commodities going down.
And then let's talk about a couple of things. Let's talk about the dollar and let's talk about China, right? So last year, one of the pushbacks that we would hear from clients and advisors around the case for commodities was the strong dollar. All right, and we had especially in the first 9 months of the year, the dollar, really, really rallied. Unsurprisingly, the Fed was playing catch up, putting rates up dramatically. The rest of the world was kind of behind. So you had this effect that would sort of, demand for dollars and the dollar strengthened. It seems like that's over. So that would be a tailwind or at least neutral for the commodities thesis this year.
No, I would view that as a tailwind. And you've got the normalizations of rates across the world, which is contributing to a normalization of dollar relative to historic means. And as commodities, virtually every commodity that we trade is denominated in dollars. As those commodities become more affordable in other currencies, that helps increase demand. So I definitely would view that as a tailwind for 2023 versus 2022. Even the markets were so strong, even despite that headwind of a strong dollar in 22, they were commodities still perform. I think if you turn that into a tailwind with a weaker dollar, you can see even greater performance.
And then what about China as well? Obviously, we were waiting to see what the Chinese response to COVID would be and when COVID zero would be lifted. And I think even the most kind of bullish and the most optimistic people were probably surprised by quite how dramatic and quick that U-turn was. Now, it's not going to be like a straight line, out of COVID. We know, in the Western world going through infections spike, pick up, people withdrawal, mobility. It takes a kind of a while to come back, but it seems like a pretty safe bet that towards the middle and second half of this year, the Chinese growth engine is going to be, at least on a cyclical basis, going to come roaring back, and that's got to be bullish for the asset class.
Yeah, I mean, I think the part that's most bullish in that is not so much the incremental demand of them coming back, but the change in market expectations. And the fact that when they were instituting COVID zero, how much that contributed to commodity bearishness and just how much outflows we saw from speculative community in the second half of 22. Like, again, despite positive returns in 22, there was a staggering amount of commodity investment deleveraging that happened in the second half. I think was largely that came from the China story. So it's the fact that they're re-engaging and seem to abandon net zero and increase of economic activity. I think the most bullish part of that is not the actual physical demand that's going to cause, but the financial demand that can cause. And we're already seeing that in the early months of this year as base metals, which are normally the biggest proxy for Chinese demand growth, is the best performing sector within commodities. Personally, I think that's actually a little bit off because, and you're asking about different sector views. I think energy should outperform base metals for the next couple of months because just like the rest of the world, what the net zero resulted in China was less social activity. Like people weren't moving around, which is
Yeah.
more a petroleum thing than manufacturing activity, which is more reflected in the base metal sector. And where we're seeing the biggest pickup in demand is in jet fuel, because China flights are happening again. I think from a physical market perspective, and again, financial players haven't quite played it this way, which is why you've seen the outperformance of base metals relative to the energy sector in January. I think that over time is going to revert. We're going to see petroleum sector start to outperform base metals, even though it's related to the China story, because that's really where demand is going to pick up.
Yeah, and we know from personal experience, all of us anecdotes, that when the ability to be mobile again comes back, you see this surge, and people want to make up for lost time. They want to go and travel. They want to get the hell out of their houses where they've spent the last, in the Chinese case, 3 years. So let's talk about, you talked about the energy versus industrial metals. Let's talk about precious metals. Gold's had quite a run recently in the last few months. What's your outlook? What's your take on what's going on in precious metals? And I think gold is increasingly becoming more and more of a question that we get.
Yeah, I think, historically I would have said all you really need to do to predict the performance of gold is look at real rates, and it would be inverse of real rates. Now, gold massively outperformed the pickup in real rates over last year, which is indicative of some other demand factor for gold that is beyond normal speculative behavior of what it looks like on a relative basis with real rates. And that can largely be explained, I think, by central bank buying, which is related to this deglobalization theme I talked about earlier. Like, there's a fear of like, well, I don't want to really be holding as much dollars anymore, and I don't know what's safe, and Bitcoin is definitely not safe. It's a speculative asset class that's ripe with potential fraud, so I can't hold that. So I'm going to go back to gold. And there was I think central bank buying that kept gold elevated despite the headwinds of real rates. I think connected with that real rates was a strong dollar, as we've already discussed. That with that turning around and no change in where that incremental demand was coming from central banks, I think the setup for gold is exceptionally positive. From the dollar basis that you asked about earlier, that's the commodity that should benefit the most from with a reversion to sort of mean levels on the strength of the dollar. And we remain very, very bullish the precious metal sector.
Yeah, I think it's not been talked about enough. Actually, I saw coincidentally that the headline yesterday, I think in the FT, was colossal central bank buying drives gold demand to decade high. The Economist has started covering this as well, and this is exactly the point that you're making in this kind of dollar reserve system, which we've been operating in for the last 50 plus years. For the first time in a while, people are seeking alternatives, and like you said, crypto is kind of off the table, and it just seems a lot of these excess reserves now are finding their way into gold demand, which is bullish. And I think the other thing as well with gold is tends to be an asset class that does well at the tails. So if you're worried about inflation, or you're worried about deflation, or you're worried about debasement, gold's generally a good place to be. So let's talk about how you invest a little bit. What are some of the, you're an active manager. What are some of the structural inefficiencies that exist in commodities that you seek to exploit and capitalize on to generate strong risk-adjusted returns?
Yeah, I think there's two different ways we sort of look at that. Like our business, as I said at the outset, is sort of divided between an absolute return, sort of relative value vehicle versus and theme-based products. And the absolute return vehicle, we really focus on the structural inefficiencies that come from the fact that commodities are not cheap to store. Like most financial securities, all you're talking about storing with them is the cost of capital. Like you're financing to hold a position, but like it's electronic. You don't really know where your stocks are being held. Like it doesn't cost anything to do that. That's not the case with physical commodities. It costs quite a bit and can be very complicated to store those commodities. Now, most financial investors play with derivatives and use futures markets that aren't really holding the physical, but the price of storage is embedded in the cost curves of those future markets. That creates inefficiencies because not every investor really understands that so well. And even if they did understand it, it's something you can't avoid. There's a physical cost of carry to these commodities. With our background and our team's background in commodities and understanding that, we can sort of take advantage of how some of the construction of some of the financial instruments that aren't totally aware of that fact and how they're constructed create inefficiencies. And that's really the basis of what our asset return strategy does. Now, we use that same knowledge in the construction of our thematic-based long-only products because we want to take advantage of structuring them in such a way where we're picking the right contracts and the right commodities, to minimize the effect of that, which will create outperformance. But the other thing I would focus on in terms of like how we view these thematic products and what we're doing is being thoughtful about the components that make up the basket for those instruments. And if you're just looking at the asset class and think I'm going to buy BCOM or GSEI because those are the benchmarks, those are very blunt instruments. They were created for commodity market diversification more than anything, and not really created for a specific investment objective in mind. And if you're trying to achieve a specific investment objective, there's likely a better weight of commodities that you could deploy, and that's kind of what we've brought to the table and how we've thought about our thematic products.
Yeah, I think it's a great asset class for active. I think there's a number of inefficiencies that people like you can identify and create value. And vis-a-vis other asset classes, I'll keep it simple. It's not necessarily what you own; it's how you own it as well. And which you just don't get. Like if you want to buy a share in Apple, you buy a share in Apple. Like end of story. You see one price on Bloomberg. If you have a view on oil, or you have a view on whatever commodity it is, you've got to think very carefully about like how do you structure that position. Let's take physical off the table. You really can't own it physically in any kind of size. So then you've got to start looking at the future contracts and where is the value, and it takes a lot of expertise. And I think just sort of structuring alpha is a really really important source of returns. But Don, anything you wanna finish on just around commodities? Anything that we didn't cover that you think we should?
No, I just want to end with a thing I briefly touched upon, is the capacity for financial capital to come back into space. I wrote about it in my recent newsletter. We estimate that over 10 billion came out of commodity retail products, ETFs, some things that are in your world. Broad-based commodity ETFs saw $10 billion worth of outflows in the second half of the year. Net specs, as measured by the CFTC, if you accumulate the weekly changes in flows based on the prices that specs were selling, a staggering 100 billion worth of commodity futures was sold in the second half of 2022. And despite that, commodities still had positive returns. BCOM was up 13%. Our indices were up over 20% in 2022, despite that massive speculative outflow. If sentiment changes, and the fact that China did reopen, the fact that people are now believing a soft landing might be achievable, the fact that we had a very warm winter in Europe that took away the possibility of financial collapse, it contributed to commodity price declines because nat gas was a big commodity that came off quite a bit. But it should contribute to more stability in terms of economic growth that you could see out of Europe. If that changes sentiment in a way where that money comes back into the space, we really could see some fairly large returns just based on the flow alone.
I mean, if you look at just Morningstar aggregate data, I think it's about 70 cents of every $100 is invested in commodities. It's a pitifully small number. And with a number of the structural drivers that you've talked about, whether they're cyclical or secular or both in nature, and you look at the 60-40 portfolio, a low cost, set it and forget it 60-40 portfolio is not a balanced portfolio in the investment environment that we're in. And the easiest, quickest, most efficient way that clients can get immediate diversification is by an allocation to quality to commodities. So with that, Don, thank you for your time today, and that concludes Views from the Harbour.
Thank you.